Welcome back. I'm going to share my screen again, and then we're going to jump straight into Chapter 3. And again, it's going to take me just a moment here to pull, where did it go? They're having a little bit of fun settings being changed on our computers, but we will sort this out. Here we go. And I should have screen and a chat window. I promise I will continue to get better at doing this quickly. There we go. All right, so welcome to Chapter 3. We have now begun the tax return. We're going to do another big section of the tax return. Same rules as always. Keep participating. You guys have been really great about that. Ask lots of questions. I'm going to try to make today interactive. We are going to be looking at a lot of numbers, just general number things, which means have your calculator ready. We're going to do some exercises together in class and some practice as well. We're going to be looking at Canada Pension Plan contributions. Today is also the day where we deal with our first schedule and our first worksheet. So we have sort of the 8 pages of the tax return, but of course we can't make it that easy. We have to have other pages that tell us what go on to those 8 pages. So we're going to do some of those today. After we do CPP, we're going to do EI, which is our employment insurance premiums. We're looking at the money that is coming off of your paycheck right now. We will talk later in the course about the other side, which is when you need the income from those programs. But for now, we're still dealing with people who are currently employed, and we're talking about the deductions that they have. Then we're going to talk about some credits, specifically the Canada Employment Amount, Volunteer Firefighters Amount, Search and Rescue Volunteers Amount. And then we're going to talk about our very first refundable credits. So we're going to be talking about a few other parts of the return and learning how they work. If you have done tax returns before and you know all about this, a whole bunch of things just changed with that last refundable credit. So even if you used to know it, the rules are different now. All right, we're going to make sure we can do some calculating of the CPP contributions as well as any overpayments or underpayments, but the overpayments are the ones we care the most about for both CPP and EI. We're going to talk about how you get the Canada Employment Amount credit. We're going to talk about how you get the Volunteer Firefighters or Search and Rescue Amount credit, what you need to do to get it, and how to put it on the return. And we're going to talk about how you can get the tax credit for eligible educator school supplies. Okay, this is not in your textbook in this chapter, but I think you should know it. So I'm going to recommend that everyone take a minute here to organize the way we're thinking about it. You've heard me use the word deduction and you've heard me use the word credit. This will be later in your book. I just think this is a better chapter to introduce it, so we're going to do it here. Okay. In real life, everyone gets these words mixed up. They use them interchangeably. Tax deduction, tax credit, it's all the same. It's money coming off the tax return. That's not actually accurate. When we're looking at the tax return, there are some very big differences between deductions and credits. If you understand the difference, it helps you to know what advice to give your clients, and it also helps you to do the tax return because it's going to organize it and help you find which page you're looking at. So I'm going to be very strict in my vocabulary as much as I can. When I mean a deduction, I'm going to say deduction. When I mean credit, I'm going to say credit. When I mean refundable credit, I'm going to say refundable credit. I recommend as well that you start practicing separating those ideas out in your head and organizing in the same way, because again, it helps you to know what part of the tax return you're looking at, and it also helps you understand what the benefit to your client is, whether this deduction or this credit is going to be useful for your specific client or not useful for your specific client. And that's partly because of how they work. So tax deductions are found on the 20,000 to 2999 line numbers. What they do is they reduce your taxable income. So they take the tax off the top and then they reduce your taxable income. Karina, I wasn't planning on sending this slide. but if you are really wanting a copy of it, now is a good time to take a screenshot on your computer. Or if you're really just, for whatever reason, as you're studying, you're like, I would like go back to that slide, let me know, and I'll see if I can send a copy. Okay. So tax deductions will reduce your taxable income, and how much they're worth depends on your tax bracket. The higher your tax bracket, the more it's worth. So if you're in the top tax bracket, you're always taking the money off the top of the return when we're talking about deductions. And then as you go down a tax bracket, that money is worth a little bit less. That deduction is worth a little bit less to you. Okay? Non-refundable credits are some of the things we're going to be starting to look at today. They are the 30,000 to the 35,000 line numbers. So they're going to start with a 3. Okay? Non-refundable credits are always 15% for everyone. Doesn't matter what tax bracket you are. First, we calculate the tax you have to pay. Then we have some credits that we can use to reduce that tax amount. It's always 15%, doesn't matter what tax bracket you're in, and you can only use them until you get your taxes down to 0. If you have more non-refundable credits, but you're already paying 0 tax, then you're just wasting those credits. And again, in the next couple chapters, we're going to start to see how that works in numbers, but that's how we want to think of them. Okay? And then at the very end of the return, we have refundable credits. Okay? Those are at the very bottom on page 8. They're lines 44,000 to 47. There should be another 0 in there, 47,000 line numbers. It is applied after the tax is calculated. So we've already calculated whether or not you have a balance owing or a refund. Essentially, everything else to that point, you're going to say, have to pay some tax, don't have to pay some tax. And then even if you have to pay no tax, you still get the refundable credit. So it's extra money on your tax return. Okay. The value differs depending on the credit. So every credit can have its own value. We're going to learn that those values can change today because one of the ones we're going to talk about, the eligible educator school supply tax credit, used to be refunded at 15%. This year is being refunded at 25%. So it used to be if you had $100, you get $15 back. Now if you have $100 of that credit, you're going to get $25 back. Okay? And then even if the client owes 0 tax, you still get money from a refundable credit. Okay? Keep that structure in your mind as you go through the next few chapters. Think about what line number it is, and then remember deductions are affected by tax brackets. Non-refundable credits are 15%. They bring your tax down to 0 and then they're wasted. Refundable credits are whatever the credit is, and they're not wasted. Even if you owe no tax, even if you're not paying any tax, you still get money back from a refundable credit. Okay, so let's look at CPP, because CPP is both a deduction and a non-refundable credit. It has elements of both. Now, when I first took this course, that was not true. So when I first took this course, Canada Pension Plan Contributions, what you paid into Canada Pension Plan through your employer, was just a non-refundable credit. That was it. And it was 4.95%. What's happened since then is the government has decided that CPP, the Canada Pension Plan generally, is underfunded. And what that means is right now they're able to pay all the people who are supposed to be getting income from CPP. But by the time this generation retires, there isn't going to be enough money in it. So they need to start taking some more money now. What they've done to do that, to make it a little bit nicer for all of us, is they're keeping the Canada Pension Plan the same, but then they're adding an enhanced portion. And they're stepping it up year by year, and we're currently in phase 1. So in phase 1, last year, it was 4.95% base, and I think it was 0.35 or something, but I don't remember because it doesn't matter. It was a smaller amount of enhanced contribution. This year, the enhanced contribution is 0.5%, so it's a little bit higher. Next year, the enhanced contribution is going to go up again to 0.75% until it hits a maximum. When it hits the maximum, which is going to be a total Canada Pension Plan deduction of 5.7%, At that point, we enter phase 2 and things change again, and we'll find out what that looks like in a couple of years when it happens, unless the government changes, and then they could change everything again. So taxes are always evolving, and we have to change with them. Okay. The way Canada Pension Plan works is you pay into Canada Pension on the money that you earn from employment or from self-employment. We're just going to talk about employment in this course. Okay, but you don't have to pay it on every dollar that you make. So the first $3,500 that you make, you don't have to pay into Canada Pension Plan, and then they're going to have a maximum. So once you hit the maximum number, that's it. You don't have to pay more. So if you're at a really, really high income, you don't have to pay more Canada Pension Plan. They have a maximum. All of the numbers on the screen right now, you should not memorize except for one, which is the basic exemption. The basic exemption does not change. Remember that 3,500 number? That's an important number. That's this one here. All the rest of them change every year depending on inflation and indexing and things like that. Okay? Can someone tell me where you can find these numbers? If I want to know what these numbers are really, really quickly, where will I go? Okay, it's not on a T1. If I go to the CRA website, it will be there, but it's hard to find unless you know specifically what you're looking for. Schedule 8 is the place to go. Schedule 8 is an extra document we use to calculate the numbers that have to go onto the tax return that are related to Canada Pension Plan. So if we're going to do a base contribution or an enhanced contribution, if we want to claim the deduction or the credit, so the enhanced contribution is deduction, the base contribution is the credit, we have to calculate it. We calculate it using Schedule 8. So all of these numbers are available in a Schedule 8. And the way that it works is we take the maximum pensionable earning, and then we subtract the basic exemption, and that gives us the maximum earnings that you have to pay CPP on. So 61,600 minus 3,500 gives us 58,100. Then we know the maximum base contribution is 4.95% of that. We know the maximum enhanced contribution for 2021 is 0.5%. And that means the total contribution, the most that anyone in 2021 is allowed to contribute to Canada Pension Plan, is 3,166.45. Okay, so all of the rest of the numbers can be calculated from the first two numbers and the percentages. But if you don't want to calculate them, look at a Schedule 8. They are all in there. Okay. When you need to calculate CPP, you're going to need two numbers for the tax return. You're going to need to know what the person should have paid, and then you're going to need to know what they did pay. So let's start by practicing what they should have paid. I've given you an employee, and I'm going to tell you their pensionable earnings is 33,500. So that's usually the same as the number in box 14. We get this number from the tax slip. It tells us what income they can pay CPP on. Okay. How much should they be contributing total? So how do we do that? You're going to take 33,500 and you're going to subtract the base exemption. Do not forget to subtract the base exemption. Everyone forgets to subtract the base exemption. It's the only number on a tax return that I memorized in my first year and have never forgotten is 3,500 for CPP. So after you've subtracted the base exemption, you're going to multiply it by the amount of the CPP, which is 4.95% plus 0.5%, which is 5.45%. And what do we get? 1,635. Okay, so you can, when you are doing this, calculate the base and then calculate the enhanced and add them together. Or if you need a quick answer, just calculate the total. For the purposes of our course, either will be fine because in real life, your schedule is going to do all the calculating for you. Just follow the directions of the schedule. But understanding how it works, where you're thinking about the client, this is how we're going to do it. Okay. So then we have information about what was actually done, because there's what should have happened and then there's what did happen, and those things might not be the same. So on a T4 slip, we have several boxes. Okay, we have box 16, which is what was actually withheld by the employer. Employers have to contribute CPP on behalf of their employees, and they also have to pay CPP themselves. So employers have two portions that they pay. The part that is from the employee's income is going to show up on the employee's T4. That's box 16. Box 26 is which of their income you have to pay CPP on, because not everybody has to pay CPP. So what are some of the requirements for contributing to CPP? Or if it helps, who doesn't have to contribute to CPP? You have to be at least 18. Okay, I'm going to jump ahead a slide for this, but let's see if you can come up with a few more. Okay, you have to be under a different age. Does anyone know what age you have to be under? 70, right? After 70, you can't contribute to CPP anymore. What else do we have? If you're on CPP disability, if you're receiving CPP income because of a disability, you do not contribute to CPP in that period of time. And then there's some specific employment where you don't have to pay CPP, like casual labor, like tips. You can choose to pay CPP on them if you want to, but you don't have to. Okay, so for some people, they will not have to pay CPP, and for some people, there will be a part of the year where they don't have to pay CPP. So for people who don't have to pay CPP, I'm going to see if I can go back a slide now. We have another box. Oh, that's not the one I want. We have box 28. If there's someone who does not need to pay CPP, usually we see this with our youngest clients, the ones who aren't 18 yet. They will have a box 28 with an X in it on their T4, and that will say they're not paying CPP. Or if they're over 70 and they're still working, they will have a CPP exempt box that will say they're working, but they don't have to pay CPP. Their employer has to keep track of that. Okay. Any questions about that? Okay. There is a small opportunity to choose not to pay CPP. So for most people, you do not have a choice. If you are employed in Canada, or if you are self-employed in Canada, if you're earning money, you have to pay into Canada Pension Plan. Okay. I had a client who came to us for what's called a second look, where they did their tax return. They got a number that they wanted. They filed it with the CRA, and the CRA disagreed with them. They thought the CRA was wrong, so they said, can you, H&R Block person, do my return and tell me that I'm right, and then go tell the CRA that they're wrong and get my money back for me. He was a person who was temporarily here from Ireland, but he'd been working in Canada and was a resident for tax purposes. And so his employer deducted CPP, and he didn't think his employer should have deducted CPP because he's never going to collect CPP because he's not planning on staying in Canada when he retires. So he just very helpfully, when he filed his return, decided to ask for all of his CPP deductions back as a refund. Turns out the government did not agree with him. Turns out the government was right. So even if you are someone who maybe will, for whatever reason, not benefit from CPP in the future, it doesn't matter. It's not an option. It is mandatory. The employers have to do it. Brittany says, honestly, he's morally right, but not legally. Kind of yes and kind of no, and because that's how CPP works. EI is the same. Everybody pays into EI who is working, but not everyone can collect EI. The idea is these types of programs, Canada Pension Plan, employment insurance, they only work if everyone contributes. The idea is some people who contribute will never collect. Some people who only contribute a little bit will collect a lot, but it is beneficial to society as a whole for these to exist. And so we need everyone working together to make it work, and that is why we do it. So for example, that particular client did routinely, because of the work that he did, work for part of the year and then go on EI for a couple of months and then work again. So he collected more EI than he ever pays into the EI program. I, however, because I tend to work part-time and then I'm self-employed and I don't pay into EI for self-employed, I pay lots of EI and I'm never going to qualify for EI. And I do that because I'm a member of society. And so, you know, his CPP is paying for my CPP, my EI is paying for his EI. We live in society, that's how it works. I did try to explain that to him. He did not agree with me. However, the CRA still did not give him more money back. He just was unhappy. So it is good to be able to explain things, but we do need to know when people have the option. Most of the time, you do not have an option. You have to pay. Let's talk about when you do have an option. So when can you choose to stop paying CPP? Or if you have stopped paying CPP, when can you choose to start? Well, we have something called a CPP 20. The big one is between the ages of 65 and 70. So yes, Brittany, you have it right. When you're 65, you can choose to stop paying into CPP. You can say that's enough. I've paid all the CPP I want to pay. I want to stop paying. You will file a CPT 30 to do that. Okay. And then if you change your mind and you're now 68 and you're like, you know what, it wouldn't hurt if I put a bit more money into CPP because I'm going to need it in a couple of years, so I'm going to start paying again. You can file a CPT 20 to start paying. The other reason to file a CPT 20 would be if you have some of that specified income where you don't have to pay CPP on it, but you could. So that would be things like tips, like casual labor. If you want to, you could pay some CPP based on that income. You do that by filing a CPT 20. Why would you maybe choose to do that? It's going to make your tax return more expensive because you'll be paying the CPP on your tax return. That money will come right off the top. Why might you choose to do that? So Leon says it's because you'll have a bigger CPP pension when you're finished. So maybe you're young and you want to start contributing. So you've got all of these odd jobs. You're not really earning a lot of employment income yet, but you don't need the money for anything else. You'd like to start paying into CPP. You can choose to do it. That being said, how many people do you think I've had as a client in all my years of doing taxes voluntarily pay more CPP than they have to? I've had none. I've had zero. No one has asked. If offered, no one has taken me up on it. It is not something most people want to do. Okay, and that's one of the reasons why CPP is mandatory, because if we all had a choice, we'd rather have our money now and we'll worry about later. So the government does require it for most people. Okay, so I want to ask a couple of questions thinking about these CPP elections. Okay, but when you do and when you don't, and who can and who can't do it. So we're going to do a quick poll here. If I can find my polls. Okay, and I want you to choose all of the things that apply. So what are the opportunities when you should file a CPT 20? All right, going to open the poll here. So I should file a CPT 20 when A, I earned money from tips and I want to increase my CPP contributions to reflect the higher income. B, I turned 65 this year, but I want to continue contributing to my CPP through my employment earnings. C, I turned 70 this year, but I want to continue to contribute to CPP through my employment earnings. D, I elected to stop contributing CPP when I turned 65, but now that I'm 68, I changed my mind and I want to start contributing again. Or E, I just turned 18 and I want to start contributing to CPP. So in which circumstances would you file a CPT 20 for your client? There might be only one, it might be all of them. You decide how many you think the right answers are. Okay, it says a 5-minute time limit. I'm not going to give you 5 minutes. I'm just going to give you a little bit longer so we can give everyone a chance to think about that. I like these questions because it makes you think about how CPP collections work, how contributions work, what is optional and what is not optional. Okay, I've got 2/3 of the class done, and I've got a few more giving it a try. I'm going to give you another, let's say, 20 seconds. Get those answers locked in. Hit the submit button if you can. Okay, I've got a couple more people. We're going to say 10 more seconds. Hit that submit button. You have an idea. Let's lock it in so we can all take a look at it together. Okay, and let's take a look at the results. So every time I do this, we get a real mix, and that's perfectly fine. So pretty much everyone agrees that if you earned money from tips and casual labor and you want to contribute to CPP, you have to file a CPT 20 to do it. You are correct. The only way you're going to pay CPP on that money is if you file a CPT 20. Otherwise, it's just not going to happen. So that is the first one. Now, if you turn 65 and you want to keep contributing to CPP, do you have to do anything? Or will it just automatically keep happening until you turn 70? What do you think? Would the government make this an opt-in program? Not if it doesn't have to. So it's automatic. You do not file a CPT 20. The government will be very confused if you do. It's just going to happen. If you don't want it to happen, you can stop it from happening after you turn 65. But if you don't do something to stop it from happening, you don't need to do anything. Now, if you're 70 and you want to keep contributing, can you? Are you allowed to put money into CPP after you're 70? No. So, not a choice. Even if you filed a CPT 20, they would not take any more money to pay into Canada Pension. So, whatever is already in Canada Pension, that's what you've got. But if you're between 65 and 70 and you stopped, and now you're 68 and you want to start again, yes. Then in order to start again, you have to tell the government you changed your mind and you want to start again. You're going to file a CPT 20. All right. And the last one, you just turned 18. When you turn 18, do you need to tell the government you want to start contributing to CPP? Nope. No one who's 18-year-old knows what CPP is, or very few people know what it is. So it's going to happen. The employer will do it. They know your birth date. They're going to start collecting it the day that you turn 18. Excellent. Good. Let's look on the other side of things. So what about stopping CPP? I'm going to do the same type of poll and ask you, when should you file a CPT 30? Okay. And again, giving you a shorter time limit, it might be all of them. It might be multiple. It might only be one. Okay. So I should file a CPT 30 when A, I earn money from tips, but I don't want to put CPP on them. I don't want to contribute to CPP. B, I turn 65 and I want to stop contributing to CPP. C, I turn 70 and I want to stop contributing to CPP. D, I turn 18 and I'm earning more than $3,500, but I don't want to pay into CPP yet. I want to keep my money. Or E, I started drawing CPP disability payments and I'd like to stop contributing to CPP because I'm taking those CPP payments. All right. So we've got 15 seconds left. Lock your answers in. Hit the submit button. I maybe should have made that poll a little bit more time. All right, hit the submit button. You've got 2 seconds left. Let's lock it in and then we'll talk about it. There we go. I'll make that one longer next time I do this course. I think that was my way of keeping myself on track. But we're doing all right for time today. Okay, let's see what the results are. Sometimes I find out in advance, sometimes I don't. Here we go. All right, so most of you figured out if you don't want to pay money on your casual labor and your other things like that, your tips, you don't have to do anything. You are correct. You don't have to do anything. So unless you make an election that year to pay CPP on it, nothing's going to happen. Okay? So That one you don't have to worry about. If you turn 65 this year and you want to stop, yes, then you must file a CPT 30. Otherwise, they're just going to keep taking your CPP deductions off of your paycheck. If you turn 70, no, it's automatic. I think you all figured that out. If you turn 18 and you don't want to contribute, do you have a choice? Nope. If you don't want to pay, they're going to take your money anyway. So, get used to it. You're going to start seeing your paychecks and you're going to start seeing all these deductions and you're not going to know what they're for, and it's just going to happen and you can't do anything to stop. And then the last one is if you've started drawing CPP disability, they already know that you are taking the income in. Your employer will also be notified and they will stop taking your CPP automatically, so you don't have to do anything. The only time you file a CPT 30 is between the ages of 65 and 70 if you want to voluntarily stop contributing early. Good. Let's keep going because now we get to the fun stuff, which is the Schedule 8. I say fun stuff. I really enjoy a Schedule 8. I think Schedule 8 is great. When you get into self-employment, it gets a little more complicated, but it's still really fun. The CRA agents sometimes have a hard time with Schedule 8, but we're going to do sort of the beginnings of it, and I think you're going to find it's not that bad if you read it carefully. So how do we find a Schedule 8? In your fillable forms, there will be Schedule 8s, or just go to the tax package. And remember how I said the main part of the tax return on the federal side is on the top, and then the other forms and schedules are down here. If we look, we can find a Schedule 8 Canada pension plan. So I'm going to open that in a new window. And I'll do a fillable one just in case I decide I want to fill things in, but I think I can make it bigger. You're going to notice, again, it has a lot of instructions. So if you're really stressed doing this and you're having a difficult time figuring out what happens, look up a little bit and read back on the page and look to the bottom of the page and read the bottom of the page. There are very helpful instructions here. Okay, how do you do this? They want you to do part 1 if you are electing to stop contributing to CPP or if you are electing to start contributing to CPP. Okay, CPT 20s and CPT 30s are filed with your employer, but on this part of the page, you have to tell the government which month you filed it on, and that's all they need to know. Okay, so if you do have a client who wants to do this and they want help with it, we can help them fill out the form. We tell them to give it to their employer. Their employer has to submit it to the government, and then we make a note of the month that happened, and that month will go in here. Okay. Part 2 is where we determine the number of months for CPP contributions calculations. We're going to come back to proration in a minute, so just remember that it exists. However, you should always have a number in box A. The number in box A will be 12 months or less than 12 months. Make sure you have a number in box A. It reminds you to be careful in case you do need to be doing proration, and that's going to change the numbers that go on the tax return. So this is something when you're doing forms by hand that people tend to forget. Really, really helpful. Always fill out box A on part 2, and it's going to save you a lot of calculating time. You're going to notice we have this very handy chart. We're going to come back to this chart later because we're going to talk about proration, but for now, let's just look at the basic form. You are going to be doing part 3. So part 3 in this course is dealing with regular CPP contributions. CPP contributions for people who are employed. We're not going to get into parts 4 and 5 where you have mixed self-employment or you have some self-employment and some or self-employment and regular employment or just self-employment. We're not going to do those. They get complicated. Those are the ones the CRA has more trouble with sometimes too. All right, we're just going to do part 3. So for part 3, remember you need to know how much you actually contributed and how much you were supposed to contribute. This is going to do all of that for you. If you read it carefully and you give it the information it wants, you will always get the right answer. If you guess at what number it thinks it wants, you're going to get it wrong. So they want your maximum CPP pensionable earnings. You're going to use the maximum of $61,600, and you might have to prorate that. We'll talk about proration. That's the most you can contribute. Your total CPP pensionable earnings is your box 26. So your T4 box 26 is going to go on that line. Then you're going to pick whichever number is smaller. So we're going all the way back to grade school math where we say which number is bigger and which number is smaller. We're going to do that a whole lot on this form. So we're going to look at line 1 and line 2, pick the smaller number. That goes on line 3. Then we're going to enter the CPP exemption. It's usually $3,500 unless we're prorating. If we're prorating, it will tell you what it is. Then you're going to take line 3 and subtract line 4 and enter that on line 5. So again, find out what that's asking you to do and do that. That's to calculate what you can. Then we're going to say what you did. So actual here, we're going to put numbers from the tax slip, and then we're going to calculate that out. Then we're going to say what you're allowed to do. We're going to say, based on the numbers we have up here, what should you have contributed? Then we're going to go down at the bottom, and we're going to see, did you have an overpayment or underpayment? I'll tell you the part where everyone gets mixed up, which is this down at the bottom. So anytime you finish a Schedule 8, go to the bottom section here. I'm going to highlight it for you. It tells you what goes on what line. Enter on line 30800, whichever is less. So look at line 7, look at line 9, pick the smaller number, put it on the line. On 22215, you're going to put the smaller number of line 8 or line 10. And then if you have a number that is not 0 or negative, can't be negative, so it's negative, enter 0. If you have anything that is positive, and in this case we usually mean $1 or more because they tend to not give you a couple of cents. If you have something positive, you're going to put it on line 44800 of the return. Now, line 30800, is that a deduction or a credit? Starts with a 3. What do we have? So I have different answers. Let's have a few more people. It is a non-refundable credit. Starts with a 3. It's non-refundable credit. What is the value of a non-refundable credit? 15%. 15% for non-refundable credits. Good. And you know which page to look for on the tax return because it's the page with all the 3s. Then we have 22215. 22215, is that a deduction or a credit? Deduction. Good. The value of a deduction depends on the tax bracket of the taxpayer. And we know which page to find it on because it says 2. Good. And then the very last one, 44800, is that a deduction or a credit? Slight trick question because I'm seeing the right words, but I want the word refundable in front of it. It is a refundable credit. Okay, and that refundable credit, you get that dollar amount. Whatever the dollar amount that it is there is what you get. Now, the tricky one, we'll talk about this in a couple of chapters towards the end of the course. If you're doing older returns for CPP, so if you're going back and filing missed returns, you can only get a refundable credit for CPP 4 years back. Okay, so keep that idea in your head, and we'll come back and revisit at the end of the class. But if you have a return that's 10 years old and you had a $400 overpayment on CPP for whatever reason, too bad. You don't get it. You get 4 years to catch your refundable CPP credits. After that, it's the government's money. Okay, excellent. So that is a Schedule 8. We're going to do a few calculations, and we get to the end of CPP, we're going to take a break because I think you're going to want a break at that point. So let me go back to the slides. And we're going to do some underpayments and some overpayments. So if you did not pay enough CPP, remember I said we have 2 numbers. We have what you actually paid and what you should have paid. Those numbers should be the same, but they're not always the same. So if you should have paid more, but you didn't, you don't have to pay anything extra. You can choose to, if you know you underpaid, you can ask by filing a CPP 20 to pay a little bit more. Again, we offer it to our clients, and then they say, no, that's okay, I'm good, thank you. Who gets in trouble for not contributing enough money to CPP? You don't have to do anything, and you don't have to catch it up. The employer, on the other hand, should not be regularly under contributing to CPP. So if the employer made a small math error, not a problem. If the employer is just not putting in what they're supposed to be putting, they're going to have to answer to the CRA and have someone take a look at their payroll and make sure that they get that corrected. So the employer is responsible for making sure CPP deductions are correct. Okay. Now, if you overpay, because what you are getting from the government is a deduction and a credit, they want to limit how big that deduction and that credit is going to be. They do not want to have someone voluntarily dump a whole bunch of money into CPP and be able to claim nice big credits on their tax return. We would say who would do that? The answer is rich people who have money they don't care about would do that. So not a good idea. So they limit it. And when they limit it, there will be an overpayment. If there's an overpayment, because you're not going to get the deduction or the credit, you're going to get your money back as a refund. Okay? So we have to calculate overpayments, and we're going to practice that. So let's do the first one. With your calculator, you have a box 26. Box 26 is your pensionable earnings. That is the money that you can or you have to pay CPP on. Box 16 is what you actually paid. In this case, in the chat, I want you to tell me if it's an overpayment, an underpayment, and how much. Okay? Don't forget the basic exemption. Everyone forgets the basic exemption. I will say for this part of the course, the number one mistake I see is you forgot the basic exemption. All right, so I've got a whole bunch of people saying overpayment of $13.75. Very good. How do you get to that number? 12,000 minus 3,500 times 5.45% gives you a number. That is what you should have paid, and you paid $13.75 more. Okay, let's try another one. Same rule. Find your box 26. Yep, if you're not fast on it, that's okay. You get to practice this in your book, and you can practice this with any numbers you want to. You can practice it with your own pay stubs. So we have box 26, 25,000, subtract the basic exemption, multiply by what we should be multiplying it by, and that'll tell you what you should have paid. You did not pay that. And I see most people saying $8.75. Good. What happens to that $8.75? You should have paid it. You didn't pay it. What does the taxpayer have to do? Nothing. What could the taxpayer do if they really wanted to pay another $8.25? 75 cents, sorry. What could they do? What form could we file for them to choose to pay a little bit more? CPP 20. 20 says, let me put more money in it. 30 says, please stop taking money away from me. Excellent. Good. Box 26 is 37,000. Box 16, I have a number for you there, 1835.68. Give that one a try. Leon, can the CRA recover for the employer? Depends on how much they've underpaid. So, $8.75 for one employee, they probably don't care. But again, if they have a history of an employer not funding CPP the way they should, yes, they can absolutely go after them for that. Okay, 37,000. I'm seeing both underpaids and overpaids. So remember, the first number you come up with is what you should have paid. The second number is what you did pay. In this case, overpayment of $9.93. Okay, where is the $9.93 going to show up on the tax return? I don't need the exact line number, but if you have it, great. It's a refundable credit somewhere in the fours. That's what I want. Because if you know that it's somewhere in the fours, when you look at the tax return, you're going to see the line that says CPP repayment, and then you know that that's where it goes. Wonderful. Good. So we're talking right now about people who have 1T4. People with 1T4 usually pay the right amount of CPP. The only time that doesn't happen in my experience is if someone either leaves a job early in the year and that's the only job they had, or if they started a job towards the end of the year. And that's just a function of how payroll works. Usually with payroll, they'll take more CPP off at the beginning of the year and less CPP off at the end. It makes doing payroll easy. I didn't understand that myself until I had to start doing payroll for a corporation. Then I was like, oh, yes, that is why you do that. It just solves all of your bookkeeping headaches right away. So you will occasionally see it with one T4. More often, we see it if someone has two T4s. So when you have two T4s, you have two jobs. Each job does not necessarily know about the other job, so they can't adjust accurately. And in that case, you are more likely to see slight variations in things like CPP and EI. So let's try this. The way we do it is we add the slips together, and then we do the calculation. So I'm going to give you all a minute there. We've got box 26 with 14,000 and box 26 with 12,000. We add them together to get 26,000. We have two different box 16 numbers. We add them together to get 1,035.50. And then you're going to tell me, is it an overpayment or an underpayment and how much? $190.75 underpaid. Pretty much everyone's agreeing. I agree as well. In this case, they have underpaid. Now, did the employers do anything wrong? Well, very, very quickly, if I look at the first employer and I say 14,000 minus 3,500 times 0.0545, I get 572.25. First employer is perfect. If I do the same for the second employer, they are also perfect. Does anyone know why there was a problem? How many basic exemptions are you allowed to get? Is it a basic exemption per employer or per all of your income? You only get one. So what could this client do so that next year they don't continue to underpay for their CPP, because they don't want to be underfunding their CPP, even if it's a little more money in your pocket? Tell both employers. Tell which employer is going to take the deduction and which one isn't, so that one of the employers will take a little more CPP off for you, and that way you will be sorted out. So you're going to have one main employer. Whichever one has the most income is usually the main employer. They're going to give you the $3,500 deduction. The other employer will take a little more off. Okay. Let's do another one. I'm going to tell you to be careful when you do this one right away. You might want to look at your Schedule 8 before you do it. So we have a box 26 for 58,000 and another box 26 for 15,000 because they had one main job and probably a part-time job. Right? Is it overpaid or underpaid, and by how much? I like to give people a heads up. All right, so we've got some brave volunteers saying overpaid at $430.55. I agree. What was the trick? What was the thing you had to notice that might have led you down the wrong path? What's the maximum? 61.6. So Again, I guarantee someone rushing through an assignment or an exam somewhere is just going to go add the number, take off the basic exemption. There it is. In this case, there is a maximum. So again, what can they do in this case to make sure that they're not having large overpayments? Because yes, it's nice to get a $430 refund, but it does mean the government has kept $430 of your money all year that you could have had and spent. So what will you do in this case? Talk to the second employer and tell them how much money you're probably making on your first employer so that they can take less off. Good. We're going to do a little bit of proration, and then we're going to take a break. So CPP proration. Remember that most people have to pay CPP all year. So if you are over 18, under 70, you haven't made an election between 65 and 70, and you're not receiving CPP disability income, you have to pay CPP for the whole year, 12 months. But maybe something happened during the year, so for part of the year, you didn't need to. In that case, we do what's called proration, which is just making a limit based on how many months you should be contributing to your exemption. So your maximal pensionable earnings will be limited and your basic exemption will be limited. You'll be contributing less CPP in the year than you would be if you were calculating it for the whole year. They have a chart. It is on the Schedule 8, and it's in your book, and it's on the slide, so you have lots of places to find it. I use the one from the government first only because they have absolutely got to make sure it's right because everyone is using it, and if they publish the wrong thing, they're stuck with it. And so in our materials, we have to update these numbers every year, and there's a lot of numbers every now and again. We might type one of the numbers in wrong. The important thing to know is for this, if you want to, you can also calculate it yourself. So you can take any of these numbers, divide by 12, and multiply by the number of months, and you'll get the same answer. So if you want to use the chart, you have a chart. If you don't want to use the chart, you can just use math. The important thing is to know how many months are we counting. So does anyone know how that works, CPP proration and counting? So let's say, for example, that you became 18. How do we start counting when you become 18? How do we find this information easily? Because I never remember. Off the top of my head, do you count the full month? Do you not count the full month? What happens? This is not something I have memorized. Go to the book. So if I go into chapter 3 of my book and I look for CPP and I look for proration, okay, I want to find out which month. And there's a really, really nice, handy, useful list. So for someone who turns 18, you prorate starting the month after their birthday. And then you count how many months are left in the year, and that's what you use in your chart. If they're electing to stop, you include the month when the election was made, and then you stop. So you're going to do all the months up to the end of the month where there was an election. Yes, you are getting CPP. That's how many you're going to put in box A of part 2, and then the rest of them you don't. Same thing, if you turn 70, it's up to and including the birthday. So from the beginning of the year up to the end of the month when you had the birthday, that's the number that goes in part A. For someone who's receiving CPP disability, it's the month that the pension is not payable, so you're not going to include the month. You're going to do all of the months except the ones where they're actually on CPP disability. So if they start it in September, they're going to go January to August, and then September will not count. And then for someone who dies, you're not going to do that tax return, but we have a rule for that as well. Okay, so let's say for an example, if your client turned 18 in September, how many months will you put in box A? You have a client, their birthday is September, they turned 18 in September. We don't count September, October, November, December. I count on my fingers. It's perfectly fine. 3. Excellent. If it's 3 months, and I go back to my chart, What will their maximum pensionable earnings be? $15,400. What will their exemption be? $875. Those are the numbers you're going to enter on the relevant lines on the Schedule 8. We're going to practice that in a minute, but keep that in mind. Any line that can be prorated, you're going to use these numbers. These are the lines that can be prorated. That's how you're going to do it. Let's try another one. What if your client turned 70 in February? They turned 70 in February. How many months are you going to put in box A? 2. Good. Include the month of the birthday in this case, but not every month after that. Wonderful. And we're going to do one more. They made a CPP election between the ages of 65 and 70 to stop paying in June. So in June, they said, I want to stop paying, and they were allowed to stop. How many months will we put in box A? 6, because we have to start from the beginning of the year all the way to the month when it was there. And again, as soon as you know it's 6, you go here. I have one more poll. Let's get the poll done, and then we're going to take a break because this has been a lot. So we're going to do a CPP Proration Poll, and I'm going to pull up a Schedule 8 to help you out with this poll. So here we have a Schedule 8. I'm going to make sure you can see the chart and you can see up to line 6 because that's what I'm going to be asking about. And yeah, I've given you enough minutes. So let's try this. Okay, and what you're going to say is tell me which lines should you prorate. Okay, so are you going to prorate line 1? Are you going to prorate the number on line 2? Are you going to prorate the number on line 4? Are you going to prorate the number on line 5? And are you going to prorate the number on line 6? Which numbers do we mess with and which numbers do we leave alone? Because if you can figure this out, you're all set to go for your review problems today. Okay, so pick the one or ones or all of them or none of them, whatever you think should be prorated. So we have 1, 2, 4, 5, and 6. Again, if you're using tax software, the tax software will do it for you, but only if you give it the right information, which means you've given it date information or you've told it if there was a CPP election. And we do need to know how to do these by hand. Okay, 30 seconds left, and we've got half the class done. Excellent. Okay, 4 seconds left. Hit the submit button. We've got one more person almost done. There we go. And in just a minute, I'm going to share the results so we can see how everyone did. I will say you all did very, very well. I am impressed and very encouraged because I know this can be a little complicated. This is an intimidating schedule, especially if you're brand new to tax returns. So again, rather than getting worried about it, just read it very slowly and very carefully, and you will get the right answer. So I think most people agreed we are going to prorate line 1. You are correct. How do you know that? It tells you to do it. It says use the number of months from line A. So the number of months from line A will tell you find the maximum CPP from the chart to a maximum of 61,600. So it can't be more than that, but take the number from the chart. That's a number that has to be prorated because we're determining how much you are allowed to contribute based on how many months you've been eligible to contribute. The next one, line 2, is a number from a tax slip. We never prorate numbers on tax slips. That already happened. The employer did the thing. Because the employer did the thing, we can't change the math. It is very, very rare that we are allowed to change a number on a tax slip. So if it's on a tax slip and it has to do with CPP, don't change anything. Okay, then we had line 4, your maximum CPP exemption. It tells you to prorate it, so you're going to prorate it. And there is the chart for maximum basic exemption proration on the side there. That one you're limited to. The exemption is also based on how many months you're eligible. Okay, then we're going to have line 5. Line 5 is math. Try not to do extra math on top of math. Just take the numbers that are there. So if it's a math line and if it's from a slip, we're not going to change it. Otherwise, we are going to change it if it tells us to do it. And then actual total contributions on line 6 is box 16 of your T4 slips. Again, if it comes from a slip, don't change it. Okay. You will, if you've already done your review problems, you will have done this once. Hopefully you remember to check the ages of the taxpayers you had in your Chapter 3 review problems, because the age matters not for whether you have to file a tax return, but it matters for how much CPP you are allowed to contribute. Okay, we're going to take a break there. This is a really good time for a break. So it is 10:43. We're going to come back in 5 minutes. I'll post the time on the chat. Everyone can get up and stretch. And I think we're going to be in really good shape for not only finishing, but getting some Chapter 3 review problems done today. So good job. Take a break, breathe, and come back in 5. All right, I'm back. Hopefully you're back. Give me an emoticon to tell me how you're feeling about CPP in general. Are you thinking, hey, that made a whole lot of sense? Or are you thinking, wow, that's really weird. I'm very confused. I'm going to give myself a moderate smiley face. I think CPP is kind of fun. I'm not a huge fan of the Schedule 8, but it's a useful form. Yeah. Best advice I can give, practice Schedule 8. The good news is you have no choice. Every tax return you have with T4s, you have to do a Schedule 8. So if you have a T4, you have a Schedule 8. Congratulations. For the rest of the course, you're going to be doing a lot of them. So if you are feeling a little bit nervous about it right now, don't worry. You're going to get to practice. And I'm going to do my best to make sure we have a chance to look at some of the practice today when we do the review problems. Okay. So let's move on. We've thought about CPP generally speaking. Just make sure I'm in the right spot. I am. Okay. So we've been talking about total income, taxable income, well, total income, net income, taxable income. We've talked about all the deductions. We get the taxable income. What do we do with the taxable income? We have to enter it on the return and calculate their tax bracket. I'm going to take 1 minute to do that now, but just one, because we covered this in Chapter 1 already. So in Chapter 1, you're going to find that this is comfortable for you. I did have a tax package open, but I've clicked on the wrong button. So I'm going to pull up for you my tax return here. And we're going to go find the page that has the tax brackets on it. You'll find in your textbook, it's going to refer to steps. I may not use the steps as a reference as often, partly because they recently changed them. So I had them all sorted out in my head in what order to do things on a tax return, and when they came up with the new format for the tax return, they have switched it. I think they switched it for a good reason. I agree with how they switched it, but it means the automatic what step am I on does not necessarily come out of my mouth the way that it says it on the form. So I will be referring to sections of the tax return, pages of the tax return, and it's always in the same order. We have our income going in first, our deductions coming off next. After we've taken our deductions off, we're going to calculate the tax you should be paying. We do that with the tax bracket. So there's part A of step 5. Part A of step 5, you're going to find your taxable income, which is your line 26000. Pick the column that you're in, fill out that column to the end, and remember that that bottom number that you're adding in is all of the tax you had to pay on the previous tax bracket income. So you have to pay 15% on the first $49,020. Then the next chunk of money up to $98,040, you pay 20.5%. And then the next chunk of money up to $151,978, you pay 26%. And so it will add the correct previous tax bracket income, and then you're just going to be calculating the tax on the top portion. Okay. Then we're going to reduce how much tax we have to pay again. So we're going to come up with a taxable income figure, federal tax on taxable income figure, and this is where the non-refundable credits come in. We want to try to take that number, and using non-refundable credits, we want to get that number as close to 0 as possible. Remember, you can't go below 0 for non-refundable credits. You can only get it down to 0, and then any additional non-refundable credits for that year you are not benefiting from. You have them, they're just not doing anything. Okay. We're going to be looking at more of these credits in the next couple chapters. So for now, I'm going to skip the first section where we have some what we call personal credits. So we will be teaching you that. But the credit you already know how to put in is this one, which is your base CPP. Remember, the base CPP is the 4.95%, which is a non-refundable credit. It's going to go in here. And there will be some additional ones we're going to talk about now that will go in here as well. We're going to talk about EI, we're going to talk about volunteer firefighters, we're going to talk about Canada Employment Amount. That's what we're doing today. Then you take all of those credits, you add them together, and if you look at the very, very bottom of this section when we finish our credits, you're going to take 15%. So it doesn't matter what tax bracket you're in, once we get into non-refundable credits, we are taking 15% federally. And again, we're going to look at this in more detail in the next couple chapters. So this is just to give you a heads up for where we're going. I've showed you that already. Let's talk about the next one. We did CPP. In addition to CPP, most people who are employed will receive will have money taken off of their paycheck to pay into the employment insurance program. Our clients might call this unemployment income. That's not a nice term. The government thinks that unemployed sounds negative and employment insurance sounds positive, so we call it EI, employment insurance. Not to be confused by EIA, which is completely different. It's disability benefits in Manitoba. So one of the problems is we use all the same letters for all our same acronyms. Federally speaking, because we're talking federally speaking now, we have employment insurance, and you have to pay employment insurance on 100% of your employment income. So from the first 25 cents you earn, you pay into EI. Remember that CPP had age limits. Does EI have an age limit? Is there an age at which you are too young, if you have a job, to pay into EI? Do you think? No. So anyone who has employment income is paying into EI. Now, that being said, there's a special rule if you have a very small amount of income. So we will see when we look at the forms that if you have a very small amount of income, you're not actually going to be contributing to EI in that year. But general principle, everyone has to pay in to a maximum, and for 2021, the maximum is $56,300. Quebec is special. We're not going to talk about Quebec. So let's not talk about Bruno. I think it's the same idea here. To borrow from a Disney song, I should come up with a cover for that. Let's not talk about Quebec for tax. So maximum EI earnings, $56,300. The rate at which you pay is 1.58%. That hasn't changed recently, so it's pretty stable. But remember, the government can change their mind at any time about how much money is needed to fund these government programs. So of course, if we take 56,300 and we multiply by 1.58, the maximum you are allowed to contribute in 2021 is $889.54. There is no exemption. There's no basic exemption, and there's no age limit. Okay, you're going to have 3 boxes related to this. One is box 18, which is the premiums that were deducted by your employer on your behalf. You're going to have the insurable earnings. Most of the income you earn will be insurable. This is not covered in great detail in the textbook, but I find it helpful. I know students ask me about it every year. So most of the time, the money that you earn from your employer is insurable, but some things are not. So there are some taxable benefits you might receive from the employer that will show up in box 14 because they're taxable, but will not be insurable. And in that case, you might notice that your box 14 and your box 24 do not match. It's perfectly fine if that happens. You take the number from the tax slip. It is the employer's responsibility to determine that. They have a whole set of instructions on the CRA for how to figure that out. Okay? There are some people who are exempt from paying EI. And again, it is not common. Most of the time we see this happen when you are a relative of the owner of the company. So if you have a company and you are a spouse or a child of the company, it's called not dealing at arm's length. So if you're dealing at arm's length with someone, you're holding them away from you because they're not your family. If it's someone you'd be willing to get closer to, you might not qualify for paying into EI. And that's because most employees, they only get to work at the company if they do a good job. Whereas if the person who you hired is your spouse or your kid, you might let them do a terrible job and still pay them a lot of money and not fire them. So the employer has a little bit more control over whether or not you're working and therefore whether or not you're going to get fired and go on EI. So for that reason, you might have a few people who are exempt from EI. Usually this happens, again, in a family-owned business. Okay. All you need to know, if you see a box 28, it will explain why your box 24 will be blank or will be 0, and that makes sense. Otherwise, if you have income in a box 14 and you don't have income in a box 24, you have to ask what's going on, because pretty much everybody's employment income should be earning or paying into EI as well. Any questions about the concepts of EI as a whole? Paying into it. We're not going to cover how you get money out of EI. That's beyond the scope of this course. You can definitely find information. There's all kinds of rules about that. And if you have more questions, Service Canada is the place to go. We will be talking about the income from EI and how to report it on a tax return. We'll be doing that later. Again, we're talking about people who are currently employed who are paying into the program as part of their pay. Okay. Just like CPP, it is possible to pay too much or not enough to EI. Also, just like CPP, if you underpay on your EI, you don't have to do anything. The employer is supposed to be keeping track of that for you. It's their responsibility, not yours. But if you overpay into EI, you don't get to claim the full amount as a credit. So EI does not have a deduction component. It's just a non-refundable credit. You're not going to get more than the maximum credit based on your insurable earnings. So you're going to get the rest of it refunded. Okay. We do this on a separate form. We don't have a schedule. The form is called a T2204. Make sure you have one available, because you are going to do this for every tax return that you do. Okay. If you are a very, very senior associate and you have done a lot of tax returns, you're going to have a sense for when you're expecting to see an EI overpayment and when you're not expecting to see one, based on just the numbers on the tax slip. You get very comfortable seeing certain numbers. And then if you're doing them by hand, you're going to have a small range of times where you're actually going to do the T2204. For this class, do it every time. If you do it every time, you will get the right answer on your taxes. If you don't do it every time, if you just guess that probably their EI was not overpaid, you might be giving your client a credit that the CRA will not give them, and you might be missing a refundable credit that they could actually be getting. So every time, if you have a T4, you need a Schedule 8 and you need a T2204. How to calculate? There are 2 steps for it. Remember, I said that there is a special rule for people who have very low income. You're going to have 2 sections. You're going to have the first section here, which is where you make sure you're putting in the maximum benefits. There is an option for people who are self-employed to pay into a special EI program. So until recently, people who were self-employed did not have the option of employment insurance. And if they ended up, say, a global pandemic hit and all of a sudden they can't earn any money from their business, there was nothing that they could do. And so there is a special program they have to pay in. That's outside the scope of this course. We're not going to cover that at all. And so your line 2 will always be 0. Okay. Now I have some really good questions in the chat window, so I'm going to go back and do that. Helene asked, does the software do this forms? It does, assuming you put the right information in. So if your information is correct, if your data entry is correct, and there's an overpayment, the computer will do a T2204 for you and will calculate it. However, one of the ways where you catch the errors in your data entry is in your mind, you're going to go, I'm looking at this tax situation. I'm expecting there might be an EI overpayment. And then you go look at the tax return and there isn't one. You might want to check that. Or if you're not expecting a big EI overpayment, and then the computer says, oh, you get $600 back for EI, don't assume the computer's right. Go look at the T2204, make sure it makes sense. It's one place where if you just put an extra 0 in somewhere, or you leave a 0 out on your EI insurable earnings, you can end up with a really unusual tax return that you should be able to explain. And then Brittany says, prior to electronic filing, the government must have killed a good many trees with all these forms. Yep, in fact, the government still kills a lot of trees, just makes us kill it for them. We keep copies of a lot of things in our offices in case we get asked to. Less than we used to. And of course, everything we don't keep, we make our clients keep. So I don't think tax returns are going to be truly paperless for quite a while. But do think about the days when all of this was done by hand. Now we have computer programs to do it for us. In the old days, we would sit in an office with a pencil and a calculator and a bunch of paper and fill the form out from the top to the bottom. And if the client then said, oh, and I forgot to tell you about, then you get to take that and you get to start at the top and change all the numbers again. Okay. So what we had in this case is we're going to do the same thing. We're going to have our maximum employment insurance eligible earnings. Then we're going to look at the total premiums deducted, and you're going to notice that there is a sort of first set of calculations, which is line 6 to 9, which most of the time is not going to be useful. So you're going to do a whole bunch of these, and you're going to say, why am I bothering with this middle section? It's never relevant. The answer is it's never relevant unless your employee is very low income, because when they're very low income, so under 2,000, you're going to have your EI refunded. Just above 2,000 and below a different number, but close to that number, you will have some or all of your EI refunded. And that's what that middle section is for those really low income clients. But fill it out all the way, all the time. Then we're going to find out if you actually have an overpayment or an underpayment. And that's going to give you the bottom section here, which will say this is what you can put on the return as a credit. And this is what you're going to put on the return as a refundable credit. Okay, and Brittany, you're already feeling the recalculating pain from doing these exercises. You will, but remember, every time you're recalculating it, you're practicing, and practicing is good. It's going to make the assignments and the exams easier. So, you know, the more mistakes you make, the faster you're going to learn. Okay, so non-refundable tax credits can only reduce tax down to 0 and not past that. Refundable tax credits can take something that's 0 and turn it into a positive. So you will get any extra back. And Helene is not seeing Brittany's comments. I'm not sure why. They are going to all. but maybe just double check for everyone there that you're sending things to to panelists. Okay, so make sure you say all participants, not all panelists. Yeah. And I'm just going to update mine because I realize I also had clicked on the wrong box there. Okay. So still talking about credits. We have done CPP credits. We've also done the deduction, but the CPP credit is what we're talking about right now. We've done EI credits. The next one is the Canada Employment Amount. The Canada Employment Amount is a credit for anyone who has employment income to a maximum credit of $1,257. You don't need to memorize that number. You need to know roughly what it is. It does change every year. Okay, so it's $1,257 for 2021. And what this does is it compensates the fact that people who have to go to work have expenses. So in the old days, you used to get expenses for all kinds of things as an employee, and you had to have receipts, and the government would audit them, and it was a really big pain. So it's like, I have to have a uniform, and I need work boots, and I have to buy my lunches at the office, and all of this is expensive, and I want credits. The government said, stop sending us receipts. We don't like it anymore. Everyone who has employment income has costs. Everyone who has employment income gets to a maximum of $1,257 credit. So you're going to take the amount of income you had from, can anyone tell me which lines we're looking at for the Canada Employment Amount? Which two line numbers do we need? What type of income lines are we talking about here? We have employment income, which is line 10100, and we have other employment income, which is line 1040. Both of those numbers together, add those numbers together, and as long as they are more than $1,257, you get the full credit. If they're less than $1,257 in 2021, you get the maximum of those two numbers together. So the smaller of the two numbers is what we pick. And then you put it on line 31260. If it's on line 31260, is it a deduction, a credit, or a non-refundable credit? 31260 is a non-refundable credit. Very good. What is the value of a non-refundable credit, assuming that you owe tax? So let's say someone actually owes some tax, you're going to get 15%. Excellent. I'm going to tell you right now, for today, you're all going to remember about the Canada Employment Amount. By the time we get to Chapter 6, you're going to forget that there's a Canada Employment Amount. So what I do when I'm doing manual tax returns, when I'm doing fillable forms, is as soon as I have a T4, I circle my Canada Employment Amount line on my tax return. And then as I go down my return, I'm going, what did I put? Okay, I did the CPP, which is on a box number on a slip. I did the EI, which is on a box number on a slip. I've got my Schedule 8. I've got this number. I've got that number. I look at my tax return, and there's something circled, and I go, why did I circle that? Oh, right, I forgot the Canada Employment Amount. Okay, this is a place where on manual forms we often forget to do it. So if you have income on either of those two lines, 10100 or 10400, as soon as you have that income in, go put the Canada Employment Amount in. Okay. Easy credit so far. Canada Employment Amount, you get it or you don't get it. There's a maximum that you can get. Volunteer firefighter and search and rescue volunteer. I'm going to just call them the firefighter amount today because it takes too long to say everything. They are the same idea. So if you are a volunteer in these areas and you have a certificate that confirms you have done 200 hours, it is up to the organization to determine how many hours and what qualifies for it. So we don't determine that. As long as you've done at least 200 volunteer hours, you can claim a $3,000 credit. Okay? Doesn't matter if you have any income or not from the volunteering. It's just how many hours. If you did the hours, you can claim a $3,000 credit. Okay? The problem we run into is, if you remember from Chapter 2, sometimes when you are a volunteer, you have some exempt income. So if you remember, we had a box 87 on a T4 with a maximum of $1,000 of exempt income. If you want the credit, you have to pay tax on the income. Okay, so If they qualify for the credit, you now have a choice. You can choose to leave the income off line 10100, in which case you don't get the non-refundable credit, or you can give them the non-refundable credit, but then you have to add the box 87 onto line 10100. Does that make sense? So you have two options: exempt income, no credit, or credit plus taxable income. Choose which one is best. The problem is, because Brittany anticipated me already, which one works out best for the taxpayer? It depends entirely on the taxpayer and their family situation. So I can't give you an answer for which one is going to be better. Sometimes it's better to have more taxable income and a non-refundable credit. Sometimes it's better to have less taxable income and no non-refundable credit. So you have to do the tax return to find out what's going to be better. You're going to find as we go through the course that there are lots of things that will affect your tax return, that they get kind of all mixed together. So maybe it's better on this person's tax return to have less income or more income and have the credit, but maybe they have a spouse who needs them to have a spousal credit, which means they need to have less income. So really, you have to figure it out every single time you look at it to see. The best way to do that is just do it both ways and see what happens. Okay. In this course for now, we'll probably tell you which one to use, or we'll hint at which one to use, because maybe we will tell you that they only worked 159 hours. And then you don't have a choice. So if you don't have a choice, you can't use the credit, might as well leave the income as exempt. Why pay tax if you don't have to? Or we will instruct you. They want to claim the credit, in which case go ahead and do it. We're not going to make you do every return twice. Don't worry about that. In real life, in a tax software, the software will optimize it for you, but I will also be showing you when we do the software how to look at the difference, and you can then get a sense for how all of these things interact. So there's no kind of, it's always better to do this or it's always better to do that. You just have to see. Your job today is to know what your options are. So if I want to claim the $3,000 credit, I have to add the income back in. If I don't want to claim $3,000 credit, I can leave the income being exempt. If there is no exempt income, if they never got paid anything, if there's no box 87, go ahead and give them the credit, because you don't have to add income they didn't get. But if they got the income, then you have to make a choice. Okay. It's a non-refundable credit, which means if their income is so low that they're not owing any tax anyway, there's no point. It's a non-refundable credit. If they're already paying no tax, non-refundable credits don't help you. Okay, and I know this one feels confusing. This is why we're going to practice it. You're going to get to practice it. The most important thing is just, if you're going to put that credit in, go back and check if you had a box 87. Make sure you don't forget to add it back into income. Okay, those of you who like flowcharts, you can start coming up with some flowcharts for how you're going to handle your tax return as you go. All right, we have one more thing to do, and then we're basically done today until we do the review problem. So last one, and this one is relatively new, and if you already knew about this credit and you knew all the rules for it, guess what? They changed this year. They're quite different this year than they were previous years, so I had to do some extra learning to make sure I was up to date on it. Again, something I love about tax returns is that you're never finished learning. There's always something else happening. Fairly new credit. It's only been around for a few years now. It is a refundable credit. So refundable, we're looking for the 4 line numbers at the very last page of the tax return. It means even if you owe no tax, you are still going to benefit from putting this credit on a tax return. Okay? You only get it if you're an eligible educator. Eligible in this case is, there's a rule for that. You have to be a teacher in high school or below. So secondary schools or post-secondary schools, university, college does not qualify. Okay. has to be in high school or less, or an early childhood educator. So a lot of daycares will have people who are certified. If you have a particular type of certificate, you'll qualify. On the other hand, you might have people who are babysitters, or they do things less formally, or they don't have that diploma or certificate. They will not qualify. Okay? Most of the people in these fields know about it because most people in these fields are either unionized or they have an employer who is educating them about it. So they will probably already know that this exists, and then your job is to help them actively achieve it. That being said, if you have a T4 from someone and they work at a school, ask, are you a teacher? If you're a teacher, great. Do you have to pay for things out of pocket that don't get reimbursed? If they don't get reimbursed and they qualify, we're going to talk about what qualifies, they can claim up to $1,000 of the expenses they paid in the year. Has to be expenses from the current tax year. So if it's a previous tax year and now they want to claim it, they would have to do an adjustment for a previous year. Has to be the year they bought it, not the year they used it. Used to be 15%. This year's 25%. So used to be for $1,000, you would get $150 back. Now you get more. Okay? Has to be related to the supplies, has to be related to your teaching. If you claim it, the CRA will probably ask you for proof. So they don't have to, but they're probably going to ask you for proof. The proof they want to see is a letter from your employer saying that you were required to buy this for school out of pocket and you weren't reimbursed. So you're going to have to get a letter or be able to get a letter from your principal or your employer if it's in an early childhood educator situation that says, yes, we did need them to buy their own things and we didn't reimburse them. Okay? And you have to keep all your receipts. So you want to make sure before you put it on the return, you talk to your client and say, do you think you're going to be able to get this? Because if they're never going to be able to get this, there's no point putting the credit on if they're going to get audited and it's going to be taken away. Okay? Most employers should be happy to do this because otherwise I would be advising my client if they won't do that, well, then they need to reimburse you. Okay? And Helene, it's a letter for employment. There's no form. Yeah, it's just a letter. Okay? What counts? Well, before I give you an exercise on that, sorry, I did want to go to the textbook because there's a really nice list in the textbook as to what you can claim. It used to be a much smaller list. So up until this year, the only things you could claim were books, games, and puzzles. Well, consumable supplies you can always claim. We'll talk about that in a minute. For physical things that don't get used up, you could only claim books, games, and puzzles, containers, and educational software, and that was it. Okay, now you're going to see we have a much longer list. So generally speaking, anything that gets used within the year, consumable supplies, things that children use and you're not expecting to have more of it left over at the end of the year. Can someone give me examples of what a consumable supply would be? What are things a teacher might buy for a classroom? Yep, pencils, crayons, paint. Disposable masks, because it's a pandemic. If they're required, are now considered consumable because you wear it once and you throw it away. Fish food, absolutely consumable, hopefully not by the children, hopefully by the fish in the classroom, but that's the idea. Good. So the types of supplies that get used up are consumable. They are always eligible. Then we have the physical things. So physical things, books, games, and puzzles, containers, and educational support software can be claimed. Okay. But generally speaking, things that continue to survive over a long period of time are not eligible for this credit. Okay, and Brittany, you have that question as well. Why can you claim the fish food but not the fish? You are correct. You claim the fish food but not the fish. That's kind of just the principle for how we do employment expenses in Canada. So this is kind of like an employment expense, but it's a special one because of how it's handled as a refundable credit. But generally speaking, you're still going to have the thing at the end of the day. So you have a benefit, you don't need a second benefit. So the rule in Canada, generally speaking, is physical objects that are going to last. You don't get a credit for on the tax return, but you get to keep the object. Things that get used up is an expense, an employment expense. And they're using this credit in the same way that they think about employment expenses. Okay. Now, I would argue that fish are fairly consumable because they don't usually live that long. You'd have to argue that one with the CRA. Okay. The new thing, the big new thing that's happening is the CRA got a lot of pushback because a lot of teachers all of a sudden in the last 2 years had to buy out of their own pockets webcams, microphones, headphones, digital timers, speakers, video streaming things, projectors, home printers, all of that stuff. And all of that stuff is physical stuff they get to keep. So the new rule is, because of the pandemic, you can now add this to it, and it's for 2021 only. So there was a question, can you go back and claim for previous years? You can go back and claim for 2020 or 2019 or the years when the credit existed, but you have to use the rules that applied to that year. So if you're doing an adjustment to an older return, you can claim things that were allowable in those years, but you can't claim things that are on the new list. So these rules are for 2021 only. As far as we know right now, this is going to continue beyond this year. So one unusual thing is a lot of the COVID special rules for tax returns have been restricted to either 2020 and 2021 or just 2021. This particular one, I think the government kind of knew that this online teaching is going to be a thing that stays with us. We have heard up until now, and this could change, you'll find out more about it next year, but it looks like it's going to stay for 2022 and ongoing, even when we start to see that most people are now back in school. Okay. There is a rule about laptops, desktops, and tablet computers. You can only claim them here if the items are only available for use in the classroom. If they can also be used personally, then you can't claim it. So it has to be those, because they're more expensive than, say, a really cheap printer or a speaker. Those things are not allowed unless it is only for classroom use. So if it's restricted, then you can claim it, but otherwise you can't. Okay? So let's try and experiment with that. I'm going to point out cell phones are not included. Everyone who has a cell phone says that they use it for work and they want to claim it on their tax returns, and you, generally speaking, can't. Okay. So let's try a little activity and do some annotating here. I haven't done much annotating today, so we'll get back into it. As always, on the left side, say yes, you can claim it under the eligible educator school supply refundable credit. On the right side for no. Okay, let me know if you think that these receipts would count or would not count. So left side means yes, I can claim it. Right side means no, I can't. If it's consumable, it's going to be yes. If it's on the specific list of prescribed goods, it's going to be yes. Otherwise, it's going to be no. Okay. And if you've taken the course from me before, you're going to notice I have updated my list to factor in some of the new things, just to get you thinking about it. Give everyone a chance, and then I will come back in and give you my official answers. Okay, I think that's a good portion of it there. Okay, so a math game for an iPad, educational software, is a prescribed good. So yes, prescribed good, absolutely. I think I'm going to give myself a nice mark over here. This one, there's my big green mark. Absolutely yes. Books, always. Books are, by default, regardless of the book, graphic novels count, considered educational. A rug for story time. It's not a consumable good. It's not on the list. No. So you all got that one right. If you have a teacher who's decorating with actual furniture, no, can't do it. Plush toys, no. They are not a prescribed good and they're not educational. Puzzles, absolutely yes. Puzzles make people think, they develop motor skills, all kinds of things. A guinea pig cage, I would argue, is a container. I would be happy to put that one on, and I would take that fight to the CRA if they want to say otherwise, because I don't want that guinea pig running around my classroom. So I would say yes for that one, under the definition of container. Like I said, sometimes it's a gray area, and you have to use your best judgment. All right. An iPad for the students in the class. Be careful on this one. You can claim educational software. You can claim a laptop for the teacher's use. Is there anything on the list that says if you buy an iPad for your students to use, you can claim it? I would argue no. You have to be careful. Okay. Maybe you could argue it's classroom use, but because of that really strict definition, and we haven't seen how they're going to do, I would be careful with that one. Okay. iPad for the teacher to use online, yes, as long as they can only use it for their teaching and they can't use it for anything else. If it's, I bought a computer because I have to teach from home, but I'm also watching Netflix on it, then no. The government will be strict about that. They will be auditing those. They will be asking what happens to that when you stop working, if you leave that school, what happens to it, all of those things. Glue guns, do you use the glue gun up, or do you have the glue gun left over at the end of the year? You have it left over at the end of the year. It is not consumable. It's not educational. Not the glue gun. What can you claim? The glue that goes in the glue gun. So claim the glue, don't claim the glue gun. So glue sticks, yes. Glue guns, no. Plastic bins, yes. Everyone forgets about the plastic bins. The storage containers are a very, very big expense for most teachers that I know, most teachers that I've had as clients, and they don't even know that they can claim them, and they spend a lot of money on it. So containers, storage containers, yes. Stickers, yep. Once you stick it on a kid or on their paper, it's gone. Leon, what about depreciation of the glue gun? You do not get depreciation as an employment expense, and this is treated the same way as employment expenses, so no, too bad for you. Guinea pig bedding, I really hope you're changing that frequently, so yes. But of course, the guinea pig, no. So the cage, yes. The bedding, yes. The food, yes. The guinea pig, no. Okay. Excellent. You are going to get to practice this a little bit and in real life. I want to make you aware of one more thing about employment expenses and eligible educator school supplies. Sometimes teachers will buy a lot of things that don't fall into these categories. In that case, there may be another option for them. So for the purpose of this course, we expect you to know how to deal with this credit. So a refundable credit, if a teacher comes in with a lot of this type of receipt, up to $1,000, go ahead and help that person get the refundable credit. Even more so, I would say now that the credit is 25%. It is going to be useful for more teachers. On the other hand, you might have a teacher who spent a lot more than $1,000 in 1 year. In that case, they do have another option, which is to make a claim for employment expenses. So that is a claim that they can make where their employer has to fill out a different form, and after their employer fills out that form, they may be able to claim the expenses as a deduction on their tax return instead of as a refundable credit. Now, that being said, the rules for what they can claim is different, and how much they can claim is different, and the documentation, the paperwork is different. We're not going to teach that in this class. I just want you to know that it exists. So if you have a teacher who bought a lot of things and they want to claim it, but it doesn't fit this particular model, or if they bought a lot of things and it fits this model, but it's way more than $1,000. At that point, you want to go find a senior person who knows how to deal with employment expenses and say, hey, can you come take a look at this? Maybe that there's a better way of putting this on the tax return. Same receipts, but we can use some different rules and we can get a different result. So I'm not going to expect you to know how to do employment expenses for teachers. There's a whole course on employment expenses. I just want you to know that it exists. Okay, good. That is Chapter 3. We have 30 minutes left. Can I ask for, we're doing a little class vote here. Give me a green check mark if you want to break before we do the review problems, or give me a red X if you want to just get them done, and when we finish, we finish. Okay. Mostly people just want to keep going. Okay. Couple of people want to break. Let's see, though. I'm going to go with the majority. So if you do want to break, I'll do my best to finish early. How does that sound? Okay. Yeah, let's keep going. I think that's both. All right. So we're going to jump in then, and we're going to take a look at our review problems for Chapter 3. Some of you will have missed things. Don't worry about getting the answers. You're going to see the answers on the recording when they're posted. You can go back and look at them. Or I will always say, send me your work. I will look at your work. I will do this however many times you want me to look at it until it's perfect. And I will answer your questions for you. For today, see how close you got. And then if you got really, really close, good, you can finish the last few things. If you got really far away, then you're going to know where you went wrong and what you need to watch for, and you can try it again. Okay? So let's take a look. We're going to do review problem 3.1, and we've got Richard Baker. Richard Baker is filing for the first time. He's a new taxpayer. For whatever reason, maybe it's his first job, maybe he didn't have a reason to file before that. I'm going to take a look at his date of birth, and as soon as I look at his date of birth, what do I know about Richard? What is really important to notice about Richard? 2003, it's 2021. We're doing the 2021 tax year. How old was he at the beginning of the 2021 tax year versus how old he was at the end of the 2021 tax year? At the beginning of the year, he was 17. And he's employed. So CPP, we have to think about. You're going to find, as you're doing tax returns, most of the time we don't care about age. There's a big range where we don't care what age you are if you're in that range. We notice a few years. We notice 17, we notice 18, we notice 60, 65, 70, 71. There's a few reasons why those years become important because we have options on the tax return or things we have to watch out for. So you're going to kind of get a sense by the time you get to the end of a tax season, when you see a certain birth date, you're going to go, aha, there's a thing I have to remember. This is one of them. So 17 at the beginning of the year, 18 at the end, and he was employed. I have to think about prorating my CPP. If you missed that, you might have gotten the right answer anyway, but you will have gotten the right answer for the wrong reason. That kind of depends on his income. So when you get to your Schedule 8, take a look. Okay? He's single. We have an address for him with an apartment. I'm going to say he's in Winnipeg, Manitoba with an R at the beginning of that postal code for me. I've got a phone number and an email. Email, do I want to sign him up for online mail? He's never filed a tax return before. He's never received a notice of assessment before, so he cannot have a My Account set up. If he hasn't got a My Account set up, do not sign him up. After he files his tax return, he can sign up for online mail anytime he wants to. You want to get him set up on My Account first. Get him, he's probably happy to use a computer, probably doesn't want to get things in the mail. Show him what he's going to need to do. Let him get signed up for My Account, and then he can choose for himself for next year if he wants to register for online mail or not. Good. So I'm not going to have an email. I'm going to highlight that. Okay. He worked at his first job. And then he did some casual labor. I have a $300 and a $200 that's got to go on my tax return because it is taxable income. Okay, he does not want to elect to make any additional contributions to CPP, but he might be able to, right? He has casual labor. If he wants to, you should have a conversation with him, tell him how it works, and he'll go, I have to pay how much on my tax return? Never mind, I'm good. But you're going to give him the option. Okay, he wants to answer yes to the Elections Canada question because he's never voted. But when he is ready to vote, when he is the right age for voting, he will already be registered, so that's great. And even though he's young, ask him about foreign property anyway. He doesn't own any, but you should ask. Okay, we have a T4 with a box 14, 16, 18. We're going to be dealing with those numbers. I'm looking at his T4 and going, that's not an awful lot of income. I'm expecting to see some of that EI income come back. It's a very low income number. I want to make sure I've done my T2204 carefully because probably there's going to be some adjusting there. Then we have insurable earnings and CPP. Why is his CPP pensionable earnings, his box 26, why is it lower than his box 14? It's 335. Because he hasn't been 18 for the whole year. We don't know how much income he earned before he turned 18 and how much income he earned after, but the employer does. So the employer has done that work for us. Our job is to take the employer's number and make sure we use it correctly on the return. And of course, union dues, don't forget the union dues. He paid some union dues. We're going to do a return for him. Now for this one, I'm going to show it to you within our tax software. So let me just find the file. It's going to give you an idea of what it's going to look like when we're using the tax software. But I want you to notice I'm still using the forms. And just to reassure you, because I don't want to ask you to do anything I'm not willing to do myself, I have also done all of the Chapter 3 ones by hand. I did them by hand first, but for today, just so that it's easier to get them up here, I have them in the software. Okay, so we have his name, we have his apartment, plus his address, Winnipeg, Manitoba, and a postal code, no email address, social insurance number, date of birth. Date of birth doesn't matter as to whether or not he has to file a tax return, but it does matter for that CPP. We're going to think about that. He's single, English, province or territory, Manitoba, don't forget that. He does not have a spouse. We're going to say yes to both of these. We're going to say no to foreign property. We're going to put in his income, 2010. We're going to put in his casual labor, 500. And that's all the income that he had for the year. Total income, 2,510. Okay, I'm going to go down to the next line. And again, I'm going to show you what I usually do, which is I go through one line at a time. So I go, okay, net income first. There's my union dues. I know the next line I'm going to hit that's relevant is going to be my CPP. So CPP, I have to think about that. As soon as I see that line number 22215, I need to do a Schedule 8. Before I can put anything on there, I have to do a Schedule 8. So let's do a Schedule 8. Okay, Schedule 8, the first thing you need to complete is Part 1. In this case, is not relevant. He can't make an election, so we don't have to worry about that. But I do need a box A in Part 2, which in his case, because of his birthday, is 5 months. So hopefully you all got 5. I will now be prorating. So when I'm prorating, I'm going to look at my proration table, and I'm going to say line 1, maximum pensionable earnings should be 25,666. Total CPP pensionable earnings I get from the T4. That's how much he earned after he turned 18. Then it says pick the smaller number. The smaller number is 335. Okay. Then I want my maximum exemption, which I'm going to prorate again. There's the proration table 145833. I'm going to take line 3, subtract line 4, and that gives me 0. Okay. So how much is he allowed to contribute to CPP? Nothing. So the rest of it you should fill out correctly anyway, but as soon as I hit nothing on that line, I know that he's going to be refunded for the CPP that was collected from him. So we're going to calculate his actual contributions. This is the basic amount. The rest of it is the enhanced. But you're going to notice I did not put 22 cents on my tax return because he doesn't get the enhanced amount because he's not actually allowed to contribute to CPP because his income was below the basic exemption. Okay. So then how much is he allowed to contribute? 0. If I go down to the bottom, I can say on line 30800, pick 7 or 9, whichever is smaller. 0 is smaller than 2. So I'm going to put 0 as a credit. And then it's going to say on 22215, pick 8 or 10, whichever is smaller. 0 is smaller than 22 cents. I'm going to put 0. And then on line 44800, if there's a positive number on 14, which there is, I'm going to do that. So now I've done my Schedule 8. I've gone back to my deduction and my credit, and I put 0 on those lines. And I've gone to the very end of the tax return, and I found my CPP overpayment, and I'm going to give him $2.36. Okay. I finished my schedule. I'm going to go back to the tax return, and I'm going to see what comes next. That's it. So we have the union dues. That's going to reduce his net income. It's going to reduce his taxable income. If you wanted to, you're welcome to calculate the federal tax. We're not requiring it, but you can if you want to. We'll be doing that in a later chapter. We're going to skip the basic personal amounts and the credits. So if you did this in a tax software, you're going to have numbers on these lines, but you don't know what they mean yet, so you're not supposed to do that just yet. What you should have, though, is we did the CPP and it was 0. The next one we come to is EI. So again, I have EI. I'm going to do a T2204. I'm just going to do it anyway. In this case, I'm especially going to do it because his income is low, and I'm expecting that he's going to have a refund on some of that, an overpayment. So EI, total insurable earnings is box 24. There it is. Total premiums deducted was $31.76. Then I'm going to get down here and I'm going to say the amount from line 3 minus 2,000 is 10. Okay? And then I'm going to take line 6 minus line 7, and that gives me line 8. Then I'm just going to remember that number exists, and I'm going to go on and I'm going to do the rest of the calculation. So the normal calculation when you don't have low income, total premiums was $31.76. The amount that he should have paid was $31.76, and he did pay that. Then you're going to go, which number is more, line 8 or line 13? Well, 8 is more than 0, so $21.76 is more than 0. I'm going to put that in here. That's going to be my overpayment. And then they're going to say which is smaller, line 7, 9, or 12. Well, 7 is 10, 9 is 31, and 12 is 31. 7 is the smallest. That's the number that I can use as the credit. Okay? So if you weren't sure or you didn't do one, make sure you've done one. You're going to put the credit of $10 in on the tax return on the credit page, and then you're going to put the refundable credit in at the end. So let's go look at those. Here's my $10 credit. And at the very end of the return, there's my $21.76. I just gave him $21.76 because he overpaid to EI because his income was very low. All right, and then hopefully you did not forget the Canada employment amount. If you have income on the first or the fourth line of the tax return, add those numbers together. In this case, it's over 2,000, so he's going to get the maximum Canada employment credit. You're going to enter it there. Then you can add that together. So 1257 plus 10 is 1267, and right now he's going to get a credit of 15% of that. That's as far as we're going to go on this case. Are there any questions about that one? No. If you missed anything, it'll either be the proration or the EI overpayment. If you didn't think to do a T2204, you might have missed the EI overpayment. Few people might have missed the Canada employment amount. Okay, those are the most common things that I see. Good. Let's do the next review problem, and then we're done. So we have Enrico Cruz, who's married to Lee. Lee works part-time. We know her net income. She's already filed a tax return. They have no children. Okay, his income was from employment and a volunteer firefighter, and he has a certificate. So now we have a choice. We can choose to give him the credit and add the income back in, or don't give him the credit and leave the income exempt. That's what we can do. He's a Canadian citizen. He does not want to update his information with Elections Canada, and he does not want to sign up for online mail, so I'm going to highlight those and make sure I don't do them. He doesn't own any foreign property. And they have some gambling winnings. Hopefully you all know by now gambling winnings, not on the tax return. All right. In this case, I have a T4 from Lighting Electric with a bunch of figures. I'm going to notice we're doing CPP EI. I need a Schedule 8. I need a T2204. Pull those forms out. Make sure you fill them out. I have RPP and a pension adjustment. Make sure you have those lines in. I don't see union dues here. I'm surprised. I might ask him if he's an electrician of some kind. Ask if he has a receipt. In this case, he doesn't, but think about it. And I have a box 38 and 39. I have security options. Box 38 is already included in box 14. I don't need to worry about it, so I'm going to cross that one off. Box 39 is the deduction. I'm going to circle that one and make sure I put it on the return. I have a box 40 already included in box 14. Put a line through it. I have a box 42. Does not affect the tax return, but I need to report it. I'm going to circle that and make sure that I put it on the tax return. So you can see my process as I go through as well. Now we have trade suppliers, same deal, go through the slip. I have income, CPP EI, make sure I add them together, think about maximums, and then I'm going to have some CPP and EI here. No union dues, a box 40, I'm going to cross the box 40 out, I don't need to worry about it. And I have one more, here's my volunteer firefighter. No taxable income, but he did get a $1,000 honorarium. I'm going to choose what I want to do with that. I can add it to income and give him the credit, or I cannot do that. Okay. Make sure you know how many hours he volunteered. In this case, he volunteered enough hours. We're going to go ahead and give him the credit. Okay. So again, I'm going to go in here, and I'm going to find my client. As soon as my computer cooperates, sometimes it complains at me. That's not the one that was updated. Where's the one that was updated? Nope, I'm in the wrong one. Enrico Cruz, that's the one I want. Calculating. Bear with me here. Aha. It likes it when it's on that screen. Here we go. Still getting used to the new setup. We're doing all right. So we have Enrico Cruz. We have his address. Don't forget the apartment number. Winnipeg. I had that happen to a client. They had an apartment building with like 500 apartments in it, and whoever had done their taxes had not put the apartment number in, and they did not get any of their mail, and their mail included checks. And it just kept all being bounced back to the CRA, and it was a real pain. So apartment numbers, watch out for those. We have a postal code. We do not have an email address. We do have a SIN and a date of birth, and he is married, and we're going to do English. He's in Manitoba, and he's doing Manitoba tax forms. And his spouse is Lee. We have her SIN number, and we have her net income. Very important. We have to have her net income. It's going to affect other parts of the tax return. I will teach you that later. All right. Elections Canada, yes, citizen, no to Elections Canada, and no to foreign property. The first number I want to make sure you all got right is the employment income. If I give him the credit, which I'm going to do, I have to add both T4s together plus the box 87. So that should give you $59,480. And I want to make sure I've reported the commissions. There it is. And that's it for his income, $59,480, and we are done that page. Next, make sure you have the pension plan deduction in and the reporting number. I want to see both numbers. In this case, I'm looking at this information, and I can tell you that he's paying into his pension plan, but last year his employer did not also contribute. It's only the employee in this case contributing. I know that because all the money that went into it this year was his money. Okay. He did not have union dues, but we are going to do CPP. So before I do anything else, I'm going to do a Schedule 8. And here we go, Schedule 8. In this case, my Part A is 12 months because we don't have to prorate. He doesn't have a reason to prorate based on his age. He doesn't have to, and he's not receiving CPP disability income. So we're going to skip the proration section. We're going to say maximum pensionable earnings is the maximum. His total is adding up all of his box 26s to the maximum, 58,480 in this case. Subtract the exemption, 3,500, gives us 54,980. Then we want his actual total contributions. What did he put in? That's his box 16s all added together. We're going to separate out those payments into the base amount, which is our credit, and the enhanced amount, which is our deduction. This is the actual. This is what he was entitled to. So in this case, did he have an overpayment or an underpayment? His required contributions were $29.96. His actual contributions were $28.05. He underpaid. We don't need to do anything on the return. We can't give him more than he actually paid. If he wants to, he could do a CPP 20 election to pay a little bit more. He's not going to want to, but we can ask him. Okay. And then maybe he should talk to his second employer and have them take a little more CPP off. Tell his second employer not to take the basic exemption off, and that will fix it for next year. Okay, which numbers we're going to take, we have to use our chart at the bottom. So line 3,800, we're going to pick 7 or 9, whichever is smaller. 7 is smaller. That's the number we're going to use for our credit. And then for line 22215, look at line 8 and line 10. Which one is smaller? Line 8 is smaller. That's the one I'm going to use. And because he underpaid, we know we're not doing a refundable credit. I'm going to take those numbers and put them on the tax return now. So there's my $257.40. That's going to go here. And there it is. I'm going to add everything in this column up together. That's the pension payments that he made, the RPP deduction, and his CPP enhanced portion. And we're going to get a net income figure of $57,222.6. We're not done. Remember, he had security options deduction. There's my $150 from the T4. So that's going to go into net income, but come off for taxable income. Taxable income is $57,072.6. Okay. Haven't taught you how to calculate federal tax yet, but if you want to, you'll notice he's in the second tax bracket federally. Haven't taught you all those credits yet, but I have taught you how to do the CPP. There it is. EI, again, I have 2 employers. I'm really going to be careful, but realistically, you're going to do a T2204 for everyone. With EI insurance, you're going to notice I've only put $56,300, even though it's more. You can total them all together, but I know I'm limited by the maximum. So I put the maximum in there because that's what it's going to be here. So you're going to see $56,300. If you have a larger number on line 1, that's also fine. Okay, I'm not worried about it because the important thing is that we're not going to go over the maximum. Okay, we're going to fill out the middle section, but because he's not low income, he's not going to be refunded anything because of being very low income. So we're going to go ahead and we're going to start on line 9. We have his total premiums, which is what was actually from his slips. So box 18 of all of his tax slips added together is 903.13. 1.58% of that is 889.54. So he overpaid. That means I'm going to take the 889.54 he was allowed to pay. I'm going to put that on the credits, and then I'm going to take that 1359 overpayment, and I'm going to put it on a refundable credit line. Okay, so there's my refundable credit, 1359. There's my EI, 889. I elected to add the money back in on the first line from the volunteer firefighter honorarium, which means I can now claim the $3,000 credit. I'm going to do that. And of course, don't forget the Canada Employment amount. When I do all of those together, you're going to add that and you should get $769,480. Okay. We have 3 minutes left, so we are officially done. For next class, please try the self-test. So there is a self-test. I believe it's at the end of this chapter. We're going to take it up next class. It's not marked, but I'm going to use polls. So if you have your answers ready to go, we're going to go through those polls very, very quickly, just to test how comfortable you are with the material in the first 3 chapters. That way you'll know if there's anything that you're still struggling with or you're finding confusing. We can address that in the next couple of chapters. We're going to do another self-test at the end of chapter 5. Okay. For next class, I would like everyone to do the self-test, read chapter 4, and complete the exercises and review problems. All right, and I will stick around for a little bit if you have more questions. Wonderful, we finished. We're done. We're good. Thank you. We got caught up. I will see everyone next week, or next class, next week. Perfect.